At times, I used to say if it was possible to grow just based on the strength of the monetary policy, many more countries would have been richer today. Thank you. It's a pleasure for me to be here at the Business Standards 4th BFSI Insight Summit. From whatever I've seen this morning on YouTube, it's going very well. So many congratulations to the organizers, and also thank for this opportunity to be here. My first instinct when I got a WhatsApp message from Mr. Bhattacharya was, I'm not so sure. I joined the RBI nearly 6 months ago, and I thought I should understand my current role very well before I come out in a public event such as this. But then he kept nudging. And because it was Mr. Bhattacharya with whom I've worked before, I just took the plunge. So here we are. What I have also done is I've taken this opportunity to write down a few thoughts, what we call at the RBI a speech. I've been asked last 6 months, why are you not giving out speeches? I usually, in my previous lives as well, spoke when I thought I had something useful to say. Now, whether it's useful or not, what I'm going to say is up to you to judge. But what I have done in my 18 to 20 minute worth of comments is that I'm reflecting a little bit on the research that I've done in the past, on what I heard in Washington, D.C. at the IMF's annual meetings, and some recent thoughts. And some of it might be new to you. Maybe the framework is something that you have not seen before, but either way. The title is Policy Frameworks for Economic Resilience, the Case of Emerging Markets in India. So as I said, I'll be reflecting on the observed economic and financial resilience of emerging markets in general, and of the Indian economy in particular. At the recently concluded annual meetings of the IMF, two contradictory themes prevailed. First, the unprecedented global policy uncertainty, which is refusing to die down, and the surprising resilience of the economies, so much so that the IMF has upgraded its growth forecast for the world. What I'm going to be focusing on is the economic resilience of emerging markets. I'm not talking about the frontier markets, I'm not talking about low-income countries, I'm not talking about advanced economies. I'm narrowly focusing on the resilience of the emerging markets. As we know, the global economy for sure has shown remarkable resilience to the shifting trade policies and geopolitical tensions. Global growth has helped up better than anticipated earlier. There have been many calls that the US is going into a recession. That has not happened yet. As I said, global growth forecast has been upgraded. Growth forecast for emerging market is holding up. Besides growth, inflation outlooks are mostly benign across countries, except advanced economies where they have been slightly higher than their announced targets. But overall, including in India, of course, inflations have been lower than the targets, which has given room for monetary policies to be eased up and to be supportive of growth. Banking sectors and financial sectors, for most part, have been resilient. Now, IMF in its analysis and its published reports, such as the World Economic Outlook, has suggested a few factors that have contributed to this resilience. I'm pointing out to a subset of those. These factors include improved policy frameworks in emerging markets, the tariff outcomes from the US, which are milder than were anticipated earlier, and in particular, hardly any retaliation by the partner countries. So tariff war has been a one-way war for most part, right? In other words, the policy-making frameworks in emerging markets and their, I would say, not being reactive to tariff policies can be credited not just for their own economic resilience, but also in some part for the resilience of the global economy. So then the key questions of interest to me are, what has made this resilience possible? Is it here to stay? And how do we contextualize India's own policy frameworks and economic resilience? So things that we hear about, I'm just trying to give it a little bit of framework and a little bit of history of where we have come and how far we have come on this journey of policy frameworks and economic resilience. So how has this resilience been achieved? And a little bit of a personal side story now. After completing my master's in economics at the Delhi School of Economics in 1991, I taught in Delhi University for 2 years. In 1993, I joined the graduate school. In my second year there, I enrolled in an elective course. It was called International Finance or International Macroeconomics. The year was 1994. The professor was very excited. He would talk about the Mexican crisis that was unfolding at that time. Despite the fact that I was very much in India, a student at Delhi School of Economics when the 1991 crisis happened, I was not sufficiently exposed to this literature or the terminology that goes with it, but it really intrigued me. The crisis in Mexico that I saw unfold as a student of international finance soon spread to Argentina and to few other Latin American countries. There were fears that there would be far-reaching contagion to many other countries in other regions. So while I took this course, I got interested in this issue. I pursued it as a part of my PhD thesis, and I learned more systematically about the pitfalls of unsustainable macroeconomic frameworks. These frameworks, what I'm calling unsustainable macroeconomic frameworks, had a few features in common. Countries would have a fixed exchange rate that they would not realign in time, which means that with higher inflation at home, their real exchange rates would get appreciated, would become less competitive, and their current account deficits will increase. They would have premature and rapid liberalization of the capital account and financial sector. It would result in excessive external borrowing. It will result in very rapid credit growth at home, and people would start worrying about bubbles forming. It also resulted in excessive external borrowing. At that time, and even till this date, most emerging markets are able to borrow in foreign currency. Researchers have termed it as original sin, that you have indebtedness, you have external indebtedness, and you have external indebtedness in foreign currency. They would have lax fiscal policy. They will not have fiscal institutions, and this laxity of fiscal policy and lack of institutions combined with somewhat ad hoc monetary policy frameworks and limited independence of the central banks resulted in fiscal dominance. There were also, if you would recall, very pronounced electoral fiscal cycles that you start spending more before each election in order to increase the probability of winning the election. These would result in high inflation and limited policy credibility. So these were the features of the economies which had crisis starting in mid-1990s with Mexico in 1994. So it became evident at that time that volatile capital flows, often triggered by external factors, could upend fragile equilibriums characterized by such frameworks. In fact, following this Latin American crisis, many more countries which had similar frameworks in place, because those were the frameworks that were known at that time, had similar crises. You would recall the Asian crisis of 97-98 that engulfed Thailand, South Korea, Indonesia, Malaysia, and the Philippines. You had Brazil and Russia in 1998, South Africa and Turkey in 2001. So a crisis period of about 7 to 8 years. It became also evident at that time that currency crisis could even take the banking sector in its fold. And there was a very interesting pioneer paper, and one of the authors happened to be in my PhD committee, Carmen Reinhardt. She wrote about twin crises. So it also became apparent that it was possible that if your banking sector had liability dollarization, if it was dependent on external flows, you could have both the crises happening almost simultaneously and feeding each other. Now, following this turbulence period, extensive discussions, analysis, research were undertaken both within emerging markets. Some of you would remember Mahathir in Malaysia, but also at the multilateral institutions, including the IMF. This culminated in a number of policy reforms that were undertaken by countries towards sounder macroeconomic management. They learned from each other and they were supported by these multilateral institutions. So now we are in a situation when since early to mid 2000s, emerging markets have become much more cautious in their approach towards the external sector. They for most part maintain a flexible exchange rate. These are mostly managed floats. These are not free floats, managed floats, which means the central banks reserve the right to modulate excessive fluctuations in the exchange rate. They have reduced and limited their liability dollarization. They have slowed and recalibrated the pace and sequencing of their capital account liberalization. They have built up large buffers of foreign exchange reserves to act as a cushion against the adverse impacts of external shocks to their balance of payments. In other words, they use their foreign exchange buffers to both modulate large fluctuations in the exchange rate or to meet the sudden demand for foreign exchange, which may come from a sudden shock to current account or reversal of capital flow. In addition, they have strengthened their domestic macroeconomic policy frameworks by implementing credible fiscal rules. So there is a database on fiscal rules which shows that the number of countries which are under a fiscal rule has been increasing. So almost all the emerging markets have a fiscal rule. A subset also has fiscal councils. They have adopted a rule-based framework for monetary policy, with inflation targeting really dominating those frameworks. They have strengthened their banking and financial sector balance sheets, and they have significantly enhanced the independence of their central banks. So a complete, I would say, 180-degree shift from where they were prior to 94 and where they came about in early 2000s. Now, fruits of these policy efforts are quite evident. The world, for most part, has not witnessed any country-specific or regional balance of payment crisis. You know, if you think about 2008-9 global financial crisis, if you think about the tapering tantrum, these were relatively large shocks, GFC being the largest of them all. But it did not take any country under. You had a COVID crisis, you had Russia-Ukraine war, you had other geopolitical tensions, you had surge in inflation in advanced economies, resulting in synchronized monetary tightening. But emerging markets have been able to withstand all of these pressures thanks to the policy frameworks they have in place. Now, this is not to say that emerging markets do not face any shocks or any policy challenges. They continue to face volatility. For most part, their policy frameworks allow them to handle these volatilities and shocks. But for me, the bigger challenge that they face is not that of macroeconomic stability that they have to continue to do, but besides macroeconomic stability issues, they face greater risk to sustained growth and meaningful employment generation. The key challenge lies in finding the new sources of growth, in learning to live in a world in which trade as an engine of growth has not done well, and therefore domestic sources of growth need to play a larger role. The acceleration in economic growth that was witnessed during the calm period of early to mid-2000s was driven by a rapid expansion in global trade. Ratio of world trade to GDP has increased over time, or had increased over time, from about 41% in 94 to 61% in 2008. You would recall that since the global financial crisis of 2008-9, the global trade to GDP ratio has flattened, which has reduced the avenues for emerging markets to grow faster based on the strength of the global trade. More recently, a new threat to global trade has emerged from the increased incidence of protectionism. Apart from reducing the contribution of external demand to growth, these developments also reduce the impact of potential spillover benefits to domestic growth through channels such as technology transfer or even finance. Even as some of the trade relations will be rebuilt and others will evolve during the course of time, it seems that the years of hyper-globalization are unlikely to return anytime soon. It's a big structural challenge that emerging markets have to grapple with. Neither is the manufacturing sector turning out to be a surer way to economic success, the way East Asian economies did a few years ago. The potential of the manufacturing sector seems to have become limited both due to the stalling global trade, but also due to the existing large players continuing to be the market leaders, and it has been very difficult to displace them through productivity gains. Another challenge, especially for those economies where demography is still favorable, is that underemployment remains high, gender gaps remain wide, and a large share of workers remain in less productive informal jobs. So macroeconomic stability for most part has been handled well, but then there are new challenges emerging in a changed global economy. For some of the emerging markets, high public debt is also of some concern, and many emerging markets have undertaken fiscal consolidation, but those challenges remain. But coming to India, where does India stand on the resilience of its policy framework? So you can see now parallel in how India's policy frameworks have emerged in the context of the global best that the other emerging markets have. India's policy frameworks have continued to evolve and are currently among the global best. Its exchange rate that was pegged until 1991 is increasingly market-driven. The external sector has been managed very well. There are inherent strengths in its diversified balance of payments. On the current account, the mercantile trade deficit has been balanced by strong services exports and remittances receipts. Oil prices is not a dampener that it used to be earlier. All in all, the current account shows resilience and has been eminently in a sustainable zone for quite some time. The capital account gets a variety of inflows, including FDI inflows that have traditionally been known to be stable, but also other kind of flows that have held up well. India has slowly but surely liberalized its capital account. But even so, the external debt to GDP ratio has been low and stable. The ratio of external debt to GDP has averaged about 20% in the last 10 years. Besides keeping the liability dollarization in check, India's short-term debt level too has remained low. The ratio of short-term debt to total debt is only 18% as of end June 2025. India has largely adhered to the path of fiscal consolidation, barring periods of significant shocks such as the pandemic. Importantly, the composition of debt and the improved quality of public spending has made public debt safe. Most of the public debt, as you know, is long-term, is denominated in local currency, is held domestically, and a large part of which is held by institutional investors, and a highly favorable growth and interest rate differential has made current level of debt very, very sustainable. Flexible inflation targeting framework, which I understand was discussed in the previous session as well, has served well. It was introduced in 2016 and has been considered a major structural reform in India. Evidence points towards improved outcomes post-adoption of flexible inflation targeting. Inflation has become lower and less volatile. Inflationary expectations are better anchored, and the transmission of monetary policy has become more effective. Inflation targeting has brought in greater transparency to policy making. Frequent communication has helped in anchoring expectations and in building credibility. This continuous engagement with stakeholders, making monetary policy a two-way consultative process. As a result of the full matrix of policy reforms, India's GDP and per capita income growth rates have accelerated over time. Growth has been among the global highest, and its volatility has declined. India's near-term growth outlook is promising as well. After growing at a stronger than anticipated rate at 7.8% during Q1 of this fiscal year, various high-frequency indicators point towards a robust economy in the second quarter as well. In the latest monetary policy statement, growth forecast for 25-26 has been revised upwards to 6.8%. Inflation is an 8-year low of 1.5%, and inflation forecast as per the latest assessment of the RBI is at 2.6% for the full year, much below the target. So just to sum up, having learned from the crisis decade of mid-1990s till early 2000s, emerging markets have put in place policy frameworks and decision-making processes that have made them less vulnerable to macroeconomic and financial instability. India has been a front runner in implementing these reforms. As a result, while the intensity of external shocks has not declined, the volatility of the macroeconomic outcomes has moderated considerably. This economic resilience has enabled the policymakers to focus on reforms to enhance productivity, facilitate ease of doing business, and improve the quality of financial intermediation. Such collective efforts are surely putting India on the path to graduate from an emerging to an emerged market status in the coming decades, if not years.
How do you think emerging markets, particularly India, should negotiate the world that is changing rapidly?
Thank you. So first, your comment on what one should aspire for India to be, a developed nation, an emerged nation, an emerged market, they go hand in hand. So you do need economic prosperity to become an emerged nation. The framing can be different, the goal is the same. So I think when you are a larger economy, which we already are, but also more prosperous economy, and you have macroeconomic stability, and your policy frameworks evolve with times, keeping in mind the complexity of your own economy and the complexity of the global economy, that's how you attain insulation from the shocks. So it's the club of countries, which are currently called the advanced economies. South Korea almost belongs to that club now. So that's the kind of transition one is seeing, and it goes hand in hand. On your question of how does one navigate the current global protectionism, is a highly relevant one. As I said, the challenge is on finding those sources of growth to put you on an accelerated growth path. And trade has not been a very strong driver in the last few years and is unlikely to revive to the extent it was during the years of hyperglobalization. So I think the two things that need to be done, which we are doing already in India, which is keeping a steadfast focus on reforms, doing better, whatever you're doing, better than before. Whether it's ease of doing business, whether it's better financial intermediation, whether it's innovation, whether it's the mindset of, R&D. And the second is strengthening your domestic drivers of growth all the more. And again, this is something we have done in India already. In India, as you would know, for its current economic size, we have been relatively more dependent on domestic consumption for growth in any case.
Yeah.
Domestic consumption is 60% of GDP. So with all the consumption supportive measures that have been taken in the last year and a half, if they have started to yield results, but hypothetically, if they can accelerate consumption even by 1 to 2 percentage points, you're getting a meaningful acceleration of GDP growth because of the sheer size of consumption in GDP. So both, getting better at what we do in every sphere of life, be it the private sector, be it policy making, be it consumers, and also continuously looking to strengthen not just the global competitiveness in seeking more markets, but also our domestic drivers of growth. And I'm happy to say that this is the direction in which we are moving as an economy.
Saurabh, if I understood you correctly, what role do you see for India's export sector in this entire scenario? In a sense that if you are staring at a world that is becoming more protectionist, how do you think we should look at the exports prospects, the exports growth scenario? Although the first 6 months figures are pretty reassuring, but going forward, how do you see the exports as a challenge, area of challenge?
So first, exports, I think it would be useful to divide into two categories,
Yeah.
services and
Absolutely.
merchandise. Services exports, we have been doing very, very well over a 2-decade period now, right? And we have the potential to go much further. Merchandise exports is a potential that we still have the room to leverage. So think of economies. So let me, for a lot of my thinking, I take a cross-country perspective. So think of countries that are dependent on natural resource. There are limits to how much they can grow. And I can think of 3 countries here, Canada, Chile, and New Zealand. Think of countries that have adverse demography. Think of countries that depend on the export of natural resource. So they sooner or later hit the limits of their growth potential. India's merchandise export basket is highly diversified, and there is a lot of potential for it to do well. We have started to see some early fruits. We have labor-intensive exports, we have capital-intensive, we have R&D-intensive, we have skill-intensive. So when you have a large and diverse country such as India, and a large and diversified export potential such as India, I don't see any reason why we cannot continue to do better than we have. So whatever export success we have had, as I said, has been in a scenario when global trade was not really happening. And we have come a long way in terms of our internal reforms and infrastructure development and policies. So for all the reasons, a highly diversified basket, we have not reached the potential in any one single sector, and all the policy attention that we have given, I see a lot of scope for merchandise trade to pick up as well in coming years.
Okay, that's very simple. On the in your brief presentation, you also talked about how India's GDP growth is fairly doing quite well, at least in the first quarter, and even the second quarter. A lot of people expect it to maintain a certain robustness. Now, in this kind of a scenario, even though the RBI's own estimates show that it's a little bit of deceleration maybe next year, how do you see, what is the role of monetary policy and also the fiscal policy, whichever you want to focus on? Is there a scope for further fiscal easing, or is there a scope for monetary policy easing in this scenario?
So usually I avoid a question on monetary policy, but that's okay.
That's okay.
I'll hazard a response. So growth is an outcome of many things. It is an outcome of fiscal policy, monetary policy, structural reform, entrepreneurship, the availability of key inputs in your country, and demand. So for me, the framing, when it's put narrowly on monetary policy, I find it to be a very partial and incomplete. At times I say lazy framing, right? So, as everybody would know, monetary policy does 2 roles. First, it structurally supports growth by keeping interest rates at a level that structurally is needed for the country. The other is it supports growth cyclically, right? But after that, okay, sure, sorry. And after that, it's a combination of many, many things that make growth possible. At times, I used to say if it was possible to grow just based on the strength of the monetary policy, many more countries would have been richer today. In fact, what we see in the examples of pre-mid-2000s is that policymakers did not have the frameworks, the holistic frameworks to grow. And so when you put too much pressure on any one part of that matrix that gives you the growth, you don't get the desired outcome. So I think if I paraphrase your question into that growth is good today, so what is the scope for monetary policy easing? And there I will repeat what Governor has been saying in his monetary policy statements, that yes, we are growing very well at 6.5, and our forecast for this year is 6.8, but that's not India's destination. That's not our potential. That's not our aspiration. So therefore, the room remains, and this is as much as we have said in our monetary policy statement, when and how much is to be seen, right?
Anything on the fiscal policy side?
So fiscal policy for most part has been very, very conducive for growth. And it has done it in two ways. One is a better tax system that is continuing to become better over time. But also a key thing is the shift on the spending side from revenue to capital expenditure. You know, all the infrastructure building that has been done through public spending, and a steadfast focus on good fiscal outcomes, good fiscal narratives, which are equally important, the transparency of budget outcomes. So I think both fiscal and monetary policy are mindful of the role that they need to play. For the future invitees, I will try not to take a question on monetary policy.
Okay, sure. Let me turn to inflation. You know, you also referred to inflation in your presentation. The current year's estimate is going to be around 2.5%. Now, if that is a kind of inflation trajectory, are we in a structural disinflation phase? And how does one deal with it? What should the investors or the market expect the inflation trajectory to be going forward?
So your question is on what the current low rate of inflation mean for the economy more widely. So I think there it would be useful to unbundle inflation into three parts, right? One is food price inflation. The other is core inflation. And the third part is your precious metals. And three inflation numbers are on very different trajectory. The current deceleration in inflation is mostly, if not fully, driven by food price inflation, which is in a deflation territory, which means that it will autocorrect, right? I mean, for something as simple as base effect. The other is core inflation minus precious metals. That is also highly range-bound this year, is likely to remain range-bound this year. But the projections as of today, and keep in mind that all projections, all forecasts are subject to forecast errors. They are made based on the best available information and technical tools that are available today. They show that core inflation will remain range-bound. A lot of core inflation is going to be higher based on the precious metals. So when you have three different drivers of inflation contributing to it, there cannot be a single narrative. A single narrative can be around the inflation trajectory over a medium to long-term period. As you would know, when inflation targeting was set in place nearly 9 years ago, inflation was running at very high levels, 8 to 10%. From there, structurally, the inflation certainly has come down to about 4%, I would say, pluses and minuses therein. And it's less volatile. So I think one major outcome that we have had is not just in the headline numbers of growth and inflation, but also equally important in the less volatility of these, more predictable outcomes, which are very, very important both from the investor's point of view and, as I said in my remarks, from the policymaker point of view. If policymakers are only fighting volatility, they have less room left to work on structural issues. So because the volatility has been tamed through highly resilient and responsible policy frameworks, the volatility is much less now. And I think that's what I anticipate going forward.
So less of volatility, that is what you are expecting.
Say that again?
Less of volatility.
Less volatility in economic outcomes, certainly.
That's right.
Certainly.
That's right. You know, I mean, your department came out with a very comprehensive discussion paper on the monetary policy framework, which is out in the public domain. People are commenting on it. Can you give us a sense of what is the time frame for it? What will be the process going forward? An associated issue is some experts are also pointing out that probably a time has come where the monetary policy framework should actively look at the liquidity management framework as well, which right now is strictly not under the domain, but although the law is a little unclear. What is the roadmap ahead on the monetary policy framework based on your discussion paper?
So the discussion paper was put out for public comments for about a month. We have received very, very rich comments. So thanks to everyone who has engaged, who has given their feedback, who have given their comments and suggestions. We received comments directly. We read each and every op-ed that was written. We read each and every editorial that was written. We even looked at the comments that were received on social media. And I think there is near majority, I won't call it unanimity, a very, very healthy majority in what has been suggested through those comments. And because they are, most of them, except the ones which are received through emails, are in public domain, you would have read them as well, that a healthy majority has suggested that we keep things the way they are, that CPI headline is the right priced inflation target. We were reminded that we'll get a revised series hopefully very soon. We have been reminded that hopefully that series would be revised periodically, that it will not take as long time lag as it took this year.
You're talking about the CPI series.
CPI series. We have been reminded that 4% target for India's current level of per capita income and growth levels is just the fine one. And that the range of 2 to 6% in today's global volatile environment is just the right range. Some people have suggested take an asymmetric range. I have written myself on these issues. Asymmetric range has its own challenges, that people start thinking that midpoint is actually the target, not the target that has been announced. So all of these are being collected currently. The process, from what I understand, is that these would be shared with the government, who would take on a call on the framework. And that is how the process will unfold. And I think, if I'm not wrong, the timeline is sometime in the first quarter of 2026. These decisions are taken. Our role is to collect all of these suggestions and inputs and share them with the government, which we would be doing shortly.
Okay, that's very helpful. Looking at the growth impulses in the economy, there is a view that so far, investment was not happening. The government was investing. Consumption is yet to pick up. But we see some changes with maybe the GST rate cut, income tax rate reduction. Are we seeing a kind of a shift more towards consumption and less on investment, because the private sector is not really coming forward? What is your sense of private sector investment, and is the government more moving towards boosting consumption because it has done its bit as far as investment is concerned? What's your overall sense on this investment versus consumption dynamics in India's growth?
So let me take a slightly broad brush view on this. I'm 6 months new or 6 months old to my current job. And we have done 3 monetary policies after we joined. As a part of those monetary policy discussions, we have extensive consultations with many, many stakeholders. And one key question that we all are collectively interested in is in the investment cycle, right? So there are 3-4 different stories around the investment cycle. One, sectorally, some sectors are doing very well on investment, we hear. That includes the renewables, that includes some auto sectors, that includes rural machines used, what do you call it, agriculture machines, etc. So first of all, investment and services sector, GCC. So investments perceived lack of pickup, perceived lack of pickup, I'll come to that, is not an economy-wide phenomenon, right? So there are certain sectors which are doing well. That's one part. The second part of the story is that capacity utilization rates that we look at are at about 74%.
Yeah.
So a key question in everybody's mind is, at what level of capacity utilization do you see more investment happening? There is no answer to that in the literature or in the practice. So potentially, it's possible that in some of the sectors, some slack is still there, which needs to be filled. So this current boost on consumption can help bridge that capacity utilization rate to a level where new investment can come into the economy, right? A third part is, if that happens, which is likely to happen, that you are giving a boost to your domestic consumption, which will help utilize your existing capacity in select sectors so that they can then invest more. Are there any real impediments then for the corporate sector to bring in new investment? So domestically, we are not seeing any impediment. So when we have these conversations, we ask, so is there anything we can do as a central bank? Is there anything you have, any suggestions for us to discuss with the broader policy making establishment? And we do not hear at least the availability of cost of finance to be an impediment, right? Corporate sector has a large pool of cash. So one interpretation can be that in the sectors where there is scope to increase capacity utilization to a level that new investments come in, perhaps demand is a constraint. And to that extent, this current policy focus then looks very, very good.
Okay.
Right? So, and it has to be synced in combination with all the other policy. You know, you hear, at least empirically, that public investment crowds in private investment.
That's right.
Public investment has happened, and I'm sure it has crowded in some private investment. You hear cost of finance is an impediment. Well, 100 basis point cut in policy rate and a whole lot of deregulation. So a lot of you hear ease of doing business that has been continuously eased up, has been liberalized. You hear private investment, and that is something that has again been done. So my sense is that overall policy environment is very, very conducive to now crowd in private investment even more.
There are some early signs where you get data which says that private sector probably is investing more in projects, maybe in a small measure, but there are signs.
Yeah, and I think another data point is, if I'm not wrong, 4, 5 or 6 months of accelerating credit growth from the banks.
That's right.
To the extent it is correlated with private investment.
You know, we have discussed monetary policy to some extent. We have discussed fiscal policy. Let me turn to the exchange rate policy. Given the fact that India does maintain relatively higher tariffs, what scope do you see for some sort of an adjustment or modification or modulation in India's exchange rate policy?
So India's exchange rate policy, as you know, the stated policy, as I also remarked on, of not just India, of almost all large emerging markets, is that they maintain a flexible exchange rate. They also maintain buffers of reserves, which they deploy in 2 conditions. One is to modulate large variations in their exchange rate, and also if there is a sudden sharp demand. You know, remember 2013, right? When reserves had to be deployed. Remember global financial crisis when reserves had to be deployed for those reasons. And this is exactly how it's practiced in India. I would also like to remind, you know, to the likes perhaps of the IMF, that excessive volatility of exchange rate is not necessarily a good thing, right? to the extent that IMF recommends to emerging markets that they should not step in at all, which means, in other words,
Yeah.
they should not perhaps even maintain their reserves. So as some of you may know, I have served for a few years. That was my first job post-PhD at the IMF. So I cut my teeth into this area at the IMF. Some of the stated policies are that why do emerging markets hold buffers when we have all kinds of contingency lines? And that exchange rate should be allowed to be a free float from what I call the managed float.
Yeah.
But at the same time, literature shows that those are not necessarily better outcomes. Those frameworks do not necessarily give better outcomes than what is practiced in emerging markets, which is managed floats and large exchange rate reserves. And that has been the Indian practice as well. Now, I think if your question is, can exchange rate give us a competitive edge in the world of tariffs? My view is it's not even a policy tool. In a market where exchange rate is, more or less determined by market forces, no country can afford to have
Yeah.
a policy tool which gives a competitive edge through exchange rate. So it's just not a policy tool available.
Okay.
So,
If I am not mistaken, in your presentation, you did talk about India moving towards more capital account liberalization. Is that a path that you see happening?
that is a path that has been taken over a period of at least 2 decades.
Yeah.
So, and that is a continuing path in a way. If you think about, Indian sovereign debt market was
That's right.
opened for index fund. That is
Yeah.
capital account liberalization.
Yeah.
So it's an incremental path, but that's the path most emerging markets are taken, and that's the path India has taken.
And that's a path that remains
I'm
open.
not privy to any discussions on
Okay.
that, but I assume that slowly
Sure.
but surely, when you become a developed nation, when you become an emerged market, the pathway is through slow and calibrated integration with the global markets.
We have come to the end of it. Would you like to take a couple of questions?
I think I'll stay safe if you have
Okay,
a
fair
last
enough.
question. Happy
My,
to
my,
take.
my last question then to you is that you painted a very nice picture of the challenges for the emerging markets, including India, and their resilience. What, in your view, are 2 or 3 biggest vulnerabilities that you think a country like India should be wary and worried about?
I think, in a way, what I said in my remarks is, I won't call them challenges, I'll call them opportunities.
Opportunities.
Right? As our senior policy makers have been telling us, I may be on the other side of the table only recently, but I have been a consumer of policies. Funnily enough, my favorite genre has been reading the autobiographies of policymakers. I wanted to understand the mindset of what they did, when they did, how they thought about it, what went on behind the rooms. So every challenge can be converted into an opportunity. I would say, steadfast focus on whatever is being done, continuing to do that. We are not at all in a situation where we have our macroeconomic frameworks which cannot, stand up to the challenge that is around us. The challenges for most part, since the global financial crisis, I would say, have been coming from the global side. Whether it's a health crisis, whether it's wars, whether it's inflation, whether it's monetary policy announcements, whether it's the fickleness of policies. So, my own, when I feel challenges in life, I say just put your head down and work harder, right? I think that is the world we live in. Just let's continue to work hard. Let's continue to have a growth and innovation mindset. Let's continue to have a service mentality. And I think we'll emerge very, very strong from whatever challenges that are put in our way.
Wonderful. I think you know, if I were to sum up this discussion, it will be a very difficult job. But there are three words that come to my mind to describe this conversation, which is, you know, realistic, pragmatic, and positive. So I think these are the three words that I would try to sum up this discussion, conversation. And we also stayed within our time. It is just 8 seconds, 7 seconds left. Thank you very much
Thank
for
you.
spending
My
some
pleasure.
time.
Thanks for the
Give her
opportunity.
a big
Thank
round
you.
of applause.
Thank you.